At age 86, you've put in 351,000 instead of 144, but your cash value grew to 1.2 million, 1.207, and your death benefit grew to 1,408. So you actually have over 200,000 of net death benefit, and that's because of all the extra dividends and PUAs that you accrued over this time. Now let's look at the so-called tax forgiveness. Well, you have a 1.2 million of cash value. You've paid 351. The differential is 856,000. If I just divide that by 3, well, that's 285,000 of taxes that you wouldn't have to pay. You didn't pay any more up front. You paid the same 9,800, but now you've saved, call it 285,000 of taxes, and your family gets an extra 200,000 of death benefit. And all of this is assuming dividends never go up from here. So did you get something for your money? Well, let's see. You paid 9,800. You actually received 285 of tax forgiveness, 200,000 of death benefit. Is this a good deal? Let's take a look. Let's measure it. So if we just take that missing money from your first 2 years of cash value, or from our 50-year-olds missing cash value, your fees may even be less. But if we take that missing $6,058 and missing 3,807, and we fast forward from age 51 all the way to age 86, and there was 200,884 of net death benefit that came in, the IRR on that is just over 9%, almost 9.1%. Now, if we take the tax forgiveness, the 285,000 of the taxes that you don't have to pay on the growth alone, and take the same amount of money, well, now it's just over 10%, almost 10.2%. Now, if we add the two together, the tax forgiveness and the net death benefit, and we say, what's the rate of return on paying $6,058, 3,807 for those 2 years, and in the future, you receive these economic benefits of 486,000, well, it's almost 12%. So is this a good use of money? Well, you're going to be the judge of that. And again, we can help you compare your own custom numbers. Just sign up with the link below, and we can run all this for you to see what your economic benefit will be. Hope to see you there.